I'd like you guys to first of all introduce yourselves. So maybe Shaaran, if you want to quickly introduce yourself and what you do at Brine.
Thanks for that, Karan. So, hey everybody, I'm Shaaran, co-founder and CEO at Brine Finance. Brine Finance is one of the leading and one of the largest spot institutional DEXs out there. We have partners with some of the largest centralized exchanges in the world, banks, asset custodians, and prime brokers. And we facilitate billions of dollars in volumes every few months. So that's largely about Brine Finance. I will let Anand.
Hey guys, my name's Anand Gomes. I'm a co-founder and CEO of Paradex and Paradigm. Paradex is a high-performance DEX built on a StockNet app chain. We're actually StockNet's first app chain. We're still in closed beta. We do about 25 million a day in volume. And we launched in closed beta on October 1st, and we should go live sometime in Q1.
Hey everyone, I'm Mark. I'm from SynFutures. For those of you who aren't familiar, SynFutures is a permissionless perps DEX which allows you to trade and list any asset with a price feed. We're currently deployed on Polygon, ZK Sync, exploring other L1, L2 partners right now, and we've done about 22 billion in trading to date. One of the things that differentiates us is we try to take like a permissionless approach to listing. So similar to what Uniswap v3 did for the spot market, we're trying to do that for the derivative space.
Cool. Thanks, everyone, and thanks, Mark. So I think just to set the foundation for our conversation today, I'll just ask a very open-ended question around where do you see we are with the DEX landscape? If you want to like take examples from some of the products that you have seen, worked, built, interacted with, and what do you see is the latest trend, or what are the conversations in the ecosystem around DEXs in general? So, Anand, if you want to maybe start.
Sure. I think DEXs are kind of seeing like a renaissance right now, right? I think it started with the fall of FTX. I think that was a big trust event that happened in the ecosystem. The whole trust in the entire ecosystem was, I guess, just like, took a shock. And since then, a bunch of other companies kind of went bankrupt. And as a result, I think, users are having a real hard time putting money on exchange, right? So I think the market is kind of demanding non-custodial solutions right now. I guess not just in DEXs, but across the board, because, it's just hard to go back to that world, especially if you've lost so much money. And so, and then that is, if you combine that with the fact that the DEX, the total opportunity size is, I think, if you look at SEX TAM, it's about 100 billion a day, and DeFi so far has only captured, let's say, 3 to 4% of that. So, you combine with this like need that the market needs something and is demanding it, and then the fact that this is such a large opportunity. So it's not surprising to see so many DEXs pop up. I think it's pretty fantastic, because there's so many people across so many chains doing so many different types of approaches. So yeah, I think it's a real good time to be at DEX right now. But of course, the competition is also fierce, right? So you really have to find that one or two, find your space in this ecosystem.
Yeah, so from my side, I see three main things, right? I mean, like at least being in the spot side of things, I three main things. First thing is something that many of the crypto folks won't like, KYC, compliance. So probably I see that already happening. Every DEX that you go there, if I'm sitting in the US, they don't let me use it. They ask me, don't use it. So we can see that happening, and slowly this will start consuming the other nations too. And the KYC, on-chain KYC would be a big part of DEXs. And the second thing, which I'm super excited about, of course, that's something that we're also building at Brine, is hybridization of DEXs with centralized exchanges. So centralized exchanges being one of the largest places of onboarding users into Web3, DeFi, and all the other places. In fact, 99% of the Web3 users today have used a centralized exchange to get in. So centralized exchanges would be, having a more centralized front end and a more decentralized back end. So all the asset management, the transfers, the infrastructure, everything would be handled at the back end. And that's something I'm super, super interested about because it will help a lot of institutions to make themselves much more resilient and also take their risk management to another level. The last thing which I feel could be in the ecosystem is about interoperability between exchanges. Love what SynFutures have been doing. I'm a personal user, by the way. So I believe storage proofs would be one big caterer when it comes to interoperabilities between exchanges. There is this team which is working on it called as Herodotus. I'm a huge lover of their team. So I believe storage proofs and interoperability will be another main thing in the DEXs in probably like the next year.
Yeah, on my end, I mean, I might be biased, but one of the big kind of shifts that we're anticipating is the growth in derivatives volume in DeFi, right? Because if you look in traditional markets, the derivatives market is typically multiples bigger than the spot market. The same is true, we see the same in CeFi, right? CeFi, I think derivatives is 3 to 5x the volume of spot. We don't see the same thing in derivatives just yet, in DeFi derivatives just yet, and part of the reason is when you look at like AMM-based derivatives DEXs, one of the major challenges is capital efficiency, right? Because of the capital efficiency problem, we don't have enough liquidity, there's not enough market depth. So I do see as we, as an industry, work to solve this capital efficiency problem, we'll bring in more liquidity and we'll start to challenge the CeFi derivatives and become a much more dominant form of trading in the DeFi space. The second kind of trend that is interesting to watch, and it's something that you guys have been leading, is for these perps DEXs to go and become their own chain, right? Their own L2. I think with the rise of like the ZK stack, ZK proofs, we're going to see more cross-chain composability, which means perps DEXs like ours may consider going and becoming our own chain. So I think this is a really interesting development. It doesn't work across all stacks, but it's something that we closely keep an eye on because we work very closely with the Polygon team. They've done an amazing job with their ZK stack, and so it's something that I think we'll see an uprise in 2024.
I think just one thing to add, I think you brought up a good point about liquidity. dYdX obviously is the place to get liquidity in DeFi right now, which is and they're kind of leading the pack. But I think the real challenge is I think we're as an industry we're really good with like all the technological innovations, right? Whether that's ZK proofs or any of the infrastructure stuff. But I still think the challenge is still liquidity, right? Like how do you bootstrap and get users, to your exchange, but not just users that are like mining the token or whatever, but users that are going to stay, right? And to do that, you apps or app chains, or projects are realizing that they need customization, right? Because they have to kind of tailor the customer experience to be able to retain the customer. And I think that's what's driving the growth of L2s, is because on L2s you have free reign to configure the block times the way you want, the time to submissions the way you want, and truly like optimize for the user experience. I think that's actually also one of the reasons why I think Antonio had listened to him on a podcast once saying that like, hey, we want to be able to cater to the end user and really tailor the experience. So I think it's coming together nicely now, where like people are realizing that like, okay, I think all the innovations on the infrastructure layer is great, but really like if we want to like move these guys over from CeFi, we really need to be able to offer like a better alternative to CeFi, and the only way to do that is to basically optimize the user experience.
Some great points, by the way. Like I think all these are relevant topics. Of course, liquidity. You mentioned about user experience. You mentioned about like how derivatives is going to be a bigger market, and what we are seeing is still in decentralized world is derivatives are like less than 2% on decentralized exchanges as compared to almost 20% is spot volumes. I think we'll come back to all of this. I think this is all important, but you did touch upon the aspect of app chains. You did touch upon the aspect of ZK proofs, rollups, and other things. Maybe just like in quick opinions around these topics, and what do you think is going to be the future? What is going to be the technology that you think will be leading? And of course, like opinions only.
I believe ZK was, it's one of the best implementations of DEXs because in ZK, the beauty is that you can prove multiple things with one transaction. And at Brian, we are a stock-based ZK exchange ourselves. So I really love how it really, works with the product because instead of sending 10,000, 20,000 different transactions on the chain, which could probably cost you maybe $100,000, instead what you can do is just create one proof that would effectively just update the balances of the users in just one chain. And that's to me is very, very, very good how ZK can do effectively optimize $100,000 worth of costs for any company in any number of transactions. And I'm a big supporter of app-specific ZK modules because I see them scaling superbly well, and I see them giving way more, performance, just like what centralized systems would do, and also the capability of moving whatever you want off-chain and having the ability to prove them on-chain is amazing. It's beautiful. So yeah, I believe I'm a huge ZK lover and a ZK pastor. Yeah. Anand.
Yeah, we're also built on StarkNet, so it's a ZK-powered L2. One of the things when we had made the decision to go with StarkNet, one of the reasons was because validity proofs we felt were a better way to power a DEX because for instance it hurts when it comes to withdrawal times. You don't want to be waiting 2 days or 3 days or whatever because I think the fraud prevention proofs, I think there's like a minimum time now. I think that time has come down now because people are obviously innovating there as well. But that was one of the anchoring principles behind, because especially when things are super volatile and you want to be moving your capital from one exchange to the other, all the institutions and users we speak to, that's a frequent request or constraint that says, hey, you know what, when we want our money, we want it now, right? And we're happy to pay 10%, but we need it, right? So I think that was a constraining principle for us, and so we went with StarkNet, and I think we've been super happy so far. But in general, I think I'm not a maxi in terms of okay, one technology is going to win. I think crypto has shown that multiple different paths can coexist, and people innovate very quickly on each of them, right? I think which is also really good to see because then you can start borrowing from each other and grow. But so far, I think for us, it's definitely been ZK-based rollups that I think are really suited for our use case.
Yeah, no, I'll look at it from a slightly different perspective. I mean, the cross-chain composability and then the potential for cross-chain liquidity is really important when we look at the ZK tech. But what really drove us to ZK is the ease of deployment, right? When we talk to our product team, especially with the rise of these ZK rollups as a service, it's just so much easier for projects to kind of deploy their own app chains when they're ready, and the maintenance requirements are much lower than running your own, dedicated chain. So that's one of the factors that we took when we looked at ZK.
Cool, no opinions on AppChain. I've already lost interest in this panel. No, I'm kidding. I think this is great. So we did touch upon liquidity earlier, and I think you also mentioned about it now. I think there's a related question to what we were just saying, that derivatives is a huge market, it's yet to pick up. And then there's another related topic of institutions versus retail. Maybe just your thoughts on how do you see all of this, and why do you think derivatives still don't have the market share in decentralized world as compared to spot? And I mean, of course, there could be some product-related thing that you want to mention, or about institutions per se. So yeah, over to you.
So I mean, the actual reason for this, at least in the DeFi world, this might come off a little bad, but from whatever we have seen, right? We've seen in DeFi, there is only a handful number of people who contribute to volumes. And the rest of the population, from what has been happening so far in the industry, it's just been people there for airdrops. They just have multiple incentives driven to that. So they're like, okay, let me just trade $10,000. Let me just trade $100,000. So I'll be able to eligible to being able to get an airdrop. So since like there is very few number of people, let's say even like if there is like 1 million or tens of millions of people, even in DeFi, you can count the number of people who actually want to trade and who are still sitting in DeFi, because from whatever customer talks that we have done, what we have seen is there is a community, of course, but it's a very niche community that's presently out there. But I'm pretty sure when the regulations tighten up, right, that's the time when these people start to go out, and the people in the TradFi market tend to go out and start exploring this more decentralized, but kind of they give you more flexibility options. And that would, be the point where you can see the derivatives market literally dominating. Because being a spot DEX ourselves, we have been seeing this over and over and over again. And that's largely one of the major reasons why we concentrate today in institutions more than what we concentrate in retail. But yeah, I mean, I'll let Mark take it up ahead.
Yeah, I think attracting liquidity in DeFi derivatives has been extremely challenging on the AMM side, and just AMMs in general are extremely hard to generate consistent yield with the risk. The risks are usually too high for LPs, right? So, different projects are approaching it in different ways. For us, what we realize is after 2 versions of a dedicated AMM, we decided we need a hybrid approach, right? So our V3, which is actually launching in February, it combines the best of on-chain order book with a concentrated liquidity AMM. And part of this is just to incentivize more capital efficiency to bring in more liquidity providers. And then to the question for retail and institution, why hasn't DeFi derivatives seen higher uptick in volume? I think on the retail side, the user experience is a problem, right? So at the very least, us as DeFi derivatives, we should offer not even a better user experience, but a comparable user experience to CeFi. And we're not there yet, right? And then to your point, because of that, everyone defaults to incentives. They're just here for the airdrops, right? Why trade on DeFi when you could get a better experience on CeFi? Maybe for the rewards, right? Same thing for liquidity miners. They're just there for the incentives. Once those incentives dries up, they're done, right? On the institutional side, the challenges in DeFi, institutions need to know who they're trading against. They need to know their counterparty, right? And as of now, a lot of us don't have these like whitelisted pools where everyone's KYC'd, because for us, that fragments our liquidity even further, right? So it's a major challenge, and I don't think we're gonna see full institutional adoption of DeFi derivatives anytime soon until we address this counterparty problem.
Yeah. I'm very sorry. Just before that, I believe we need to have some kind of a KYC flag in all the DEXs so that, you can toggle that KYC flag, and whomever else has toggled that KYC flag, their orders could actually be matched. Because of this, the liquidity fragmentation problem will not be there, because if you have turned on it, you can actually match with both, like KYC and non-KYC people. But yeah, Anand.
I have a slightly different take on it in the sense that if you look at, like, if we're trying to move CeFi, derivatives volume over, you talked about being a comparable experience. If you look at okay, what does that mean, right? So if you look at it from an institution standpoint, or at least the guys that are trading the most volumes, which tend to be the high frequency traders, they need basically 5 to 10 millisecond latency on order matching, right? No DEX, if you put the order book on chain, I think Solana is the fastest, which is 400 millisecond block time. I mean, that's a hard stop, right? So you can't do that. So, so then it necessitates a hybrid approach, which I think dYdX, you guys did, is you put the order book sort of off chain, right? But it's not just about the order book and the performance of the order book. It's also about, okay, if we want to build a derivatives DEX on chain, it means that we need to be able to, in true DeFi sense, we need to be able to guarantee the non-custodial properties of the system. You need to be able to guarantee the integrity of the business logic, which means that all the complex business logic that goes into validating a derivative transaction, whether that's initial margin, variation margin, liquidations, all of that stuff needs to be on chain. Now, to do that, and then also have a performant sort of order book, that's a very hard problem to solve, right? And not surprisingly, there's only one company, till date that dYdX that has basically been able to solve that. And of course, that required deep collaboration with Starkware and so on and so forth. But it is a very hard problem to solve. And so, we know that because we're doing it right now, right? And so, I think the companies that are able to basically, you talked about the comparable experience, are able to move that, high performant, low latency, full, but also guarantee the integrity of assets and the integrity of the business logic. Those are the companies that will sort of like go ahead, right? And so I think it's like you first need to solve like this problem and do it kind of well, and then you'll sort of see market share, come up. And I definitely think there's more room for people in the market. It's definitely not, I mean, we've seen in CeFi, right? There's about, 100 exchanges, but there's room for probably about 5 or 6, right? And in DeFi, if you only have one, there's probably room for more. So, so I'm pretty optimistic. I definitely think we can be one of these exchanges. But I think that needs to be solved at scale first, right? And L2s, the infrastructure is, I wouldn't say it's super mature, but it's like, it's there and you can build scalable, systems on it. But there's still a lot of like stuff that we don't know, like how do cost scale with volume, things like that, because there's no data, right? You're kind of like figuring this out as you go. And so, you kind of have this parallel tracks where you have a super complicated problem. First you need to solve it, and then you need to figure out how that thing scales. And so it will take about a year. But I think, and at least in my estimation, but then I think once you're there, then you'll really start to see, market share kind of, move over from CeFi to DeFi, because at the end of the day, for a CeFi user, if I'm getting a better or equal experience in DeFi and I'm getting to an ownership or a piece of the network, I mean, why wouldn't I go, right? So I think, it's set up to be a really good time for DEXs.
Yeah, some, I think, great important points there, both from technical and regulatory fronts, of course, that are impacting the industry overall. I'll switch gears a bit. I'll move towards the other aspect of decentralization, which is around governance, DAOs. But before that, just wanted to say, like, if we'll keep a couple of minutes at the end for any audience questions. So yeah, if you have anything for the panelists, please prepare it for that. Yeah, so coming back to the conversation around decentralization, of course, the technology stack, non-custodial aspect of decentralization is, of course, very important. The other question is around the entire aspect of governance, DAOs, and how that fits into the narrative, right? So first of all, yeah, I would like to hear your thoughts, and if you have some additional like depth that you would like to add on the institutional side, how the people that you talk to, how they'd look at this entire landscape. I was talking to a reporter yesterday, and I was trying to break down these concepts, and still complex for people who are not familiar with the ecosystem, right? So yeah, please feel free to share your thoughts on that.
I'm happy to go too. I just didn't want to talk a lot, but yeah, I mean, look, I think it matters which type of institution you speak to, right? You have your crypto native institutions that are very comfortable with having a MetaMask and dealing with DeFi and owning the private keys, etc. So with them, I don't think you have too much of a problem because their level of sophistication is pretty high. It's when you start to kind of move to like the next tier, right, where these guys are either pseudo regulated or they have some authority that they need to report, or they have investors or a mandate that they need to abide by. That's when you start running into these sort of like trust issues, right? I think that at least until the governance architecture or the governance sort of like infrastructure around DAOs and becomes kind of like a playbook, right? In terms of like like in VC, for instance, over many years, like all the terms that go into like what terms are negotiated, that's had like 30 years of evolution, right? That's not happened in DeFi yet, right? We're still kind of figuring out these new systems. There's no regulatory clarity. So it's kind of like a many uncertainty problem. And until you sort of like solve, we just have to go through the process, right? I think it's going to take some time, but once that's done and people sort of see established norms, and then of course you get, the catalyst from regulation, as you said, which hopefully will provide, a tailwind, then I think you'll start to see, the next tier of people sort of come into the ecosystem, right? But I think for now, at least for the next 12, 24 months, it's going to be restricted to the folks that already are comfortable. And of course, as a product builder, you want to make it easy, right? So you're going to solve the product challenges, but there's still going to be issues around, okay, what is a DAO? Like, how does that govern the ecosystem? What is a token? Like, those are not easy things to grasp on top of the technological, the novelty that comes with this ecosystem.
Yeah, so one thing with DAOs for DEXs is, of course, if you want a DEX to be truly decentralized, you have to go with the DAO one way or the other. But one thing that I've seen is that when you make your entire decisions governed by a DAO very fast before hitting product market fit or literally getting out there, it becomes a huge, huge problem, because the number of people who would be there inside your project and who would be actively involved, majority of them at the early stage would honestly be there just for the incentives. And in fact, for example, if it's a very new project and if you start up it with a DAO, and if you just end up putting a thing, how many of you guys want us to airdrop in the next month? I'm pretty sure 99% of them will say yes. And that's the pretty truth. And so it's very essential to understand when to have any specific project or company or anything to be governed by a DAO, because I believe that's one of the most crucial factors, at least in the Web3, at least as of today, from whatever I've seen with my friends and a couple of other projects doing that as well. And of course, on traditional finance systems, opting for decentralized finance system, as Mark mentioned very correctly, KYC is a very, very, very important thing, because they need to know their counterparties. And in fact, that's having worked with a couple of banks ourselves with Brian. That was literally the first question they asked: do I know my counterparty? Can I somehow show to the government that I'm trading with these people? And once you start giving them that, they are super, super happy to go with you, because the existing centralized exchange sphere that's superbly well known for their custody, their banking partnerships, provide a much higher economic rate. They charge you maybe 1% or 2%. But at the same time, when you use a DEX, you get lower fees, higher amount of throughput, lower amount of latency, and at the same time, you get to keep your funds with you, which means that it's the best bank for all the banks that's out there. So yeah, that's largely my views on this. Mark, please.
Yeah, decentralized governance is something we've been thinking about a lot recently, just because, with our V3 launch in February, we feel like we're in a good place on the product side, on the community side. So we're now thinking about how do we decentralize what we're doing, and we think about DAO governance. Still a lot of challenges, like a lot of pitfalls that make it similar to like your traditional kind of, corporate structures. One example is concentration of decision-making based on the size of your bag, right? And that's not necessarily the right approach. We think about how do we do a combination of not only the size of your bag, but your contribution to the community itself, so that you don't have this concentration risk at the very top, right? Whether it's all VCs, founding team, et cetera, because you do want some of the smaller kind of community members to have a say in the direction of the project. The other challenge, though, is like DAO participation still remains extremely low. I think the last stats I've seen was 17% or 20% of proposals get voted on by the community, and it's a major challenge. Part of it is you can't expect DAOs to govern every little thing through their community, because some of the smaller decisions, I don't think everyone wants to participate in, number one. Number two, there are some barriers, right? Like, I'm in a bunch of DAOs, I want to vote on things, but I'm not willing to pay gas for this specific issue. And so I think we need to figure out some of this user experience gaps of DAOs before we have, full adoption. So.
And any interesting token economic models that you're seeing or incentive structures that you're seeing which are like facilitating governance or making people more engaged? An open question for all.
I mean, there is quite a few that I really love how the DAO essentially works like. I mean, this might be a little surprise for many people, but I used to love Tron DAO very much, despite the number of things that people get. But because of if you see the number of participation that you get in Tron DAO, it's amazing. And also, like as also Mark mentioned, one of the bigger challenges, at least in the DAO ecosystem, is that like you have to give more, more power to people who have actually contributed to your business, your company, or your project. But rather, for the sake of decentralization, we end up giving everybody equal amount of power. That kind of takes out a lot from the projects. So yeah, I mean that's largely my views. Anand.
I think one thing just to quickly touch on is, I like, this sub-DAO structure where you like, everybody doesn't have to vote on everything. You kind of delegate some authority towards some group of people, whether that's a sub-DAO, and allow them to make the decisions, for the best of the community, because it's just not scalable, right? Everybody can't be involved in every decision. I mean, you kind of already see, I mean, it's kind of stupid, but I feel like crypto is learning some of the lessons of what it means to run a company and having, board of directors and things like that, right? And I think a lot of those lessons there soon, I think it'll start to look a lot like what a traditional company looks like, except, it applies to a collective, right? Which I don't think is a bad thing. I think it's a good thing. Why do we need to, make the same mistakes that, other people have done before? If it's there, just use it.
Cool. Great. I think we are on time, and I'll just take a quick pause here. If there are any questions, maybe we can take one or max two questions from the audience. Yeah.
Decentralized exchanges?
No, I think it's just staying away. I think there's Bangsa, there's a couple other people that do it, but I haven't really seen any different models. I think they're pretty standard now at this point.
We have one more question. I think we can take one more. Yeah.
My question is how DeFi will attract institutional volume, because by nature, you will not be able to identify, and hence the risk that will come from regulators whom you are dealing with. So how you think that can be solved? I know pure DeFi it cannot be, but how it will evolve and solve eventually?
Firstly, I believe principle is a super important term, at least in the institutional space. And I mean, in fact, to literally everybody. But in case if you want to have custody of your assets, because you don't want to put your funds and you don't want another FTX to happen. So I believe like decentralized exchanges are the best way, and they're the more guaranteed way to ensure that your funds are always with you. And the second part is that one thing that we have specifically been working around with all the institutions and banks is that we have like a small KYC flag wherein if you are a KYC user, you can choose to either get matched only with the rest of the KYC folks, or you can also choose to actually have matched with both KYC'd and non-KYC'd folks. So that gives you effectively the knowledge of whom you are actually like trading with and your counterparties. And I believe like when you know both of this and you're also capable of trading 10,000, 20,000 times in a second, that kind of matches what you would be getting in a centralized exchange with a lower amount of fees. So I believe that could be financially and from a custody perspective a lot better for many of the institutions that's out there.
I'll quickly add, I think it's a little bit of a misconception that DEXs don't know who they're dealing with. At least all the if you're a major trader, there's no way you're going to be trading with, on a particular exchange DEX if you don't know the team, right? Like you have to have some interaction. I'm sure you guys see this as well. But in addition to that, I think DEXs also implement a lot of KYT, wallet screening from Chainalysis, TRM Labs, geo-blocking, proxy blocking, which is like VPN blocking. I know we're doing it. At this point, I think it's a stable requirement. If you're not doing it, then you're probably going to run into trouble with the regulators, right? So there's a lot of happening behind the scenes that people don't talk about as much, which is already like way better than, I mean, it's this impression of this Wild West that everybody's trading and nobody knows what's going on is simply not true. There's tons of, people have to know each other, right? Especially if you're trying to deposit a lot of money into the project or on smart contract, you want to know the team. You want to understand like their pedigree, whether they're, from a security standpoint, like audits don't really get you there. There's still a human element to it. Now at scale, let's say we get to like 100, 200 million users, then okay, I think, then it's a bit challenging, but as long as you have, these kind of like on-screen blocking and identification tools, which by the way are very powerful. I think Chainalysis is able to track something like 6 million wallets, and basically you can block those wallets from depositing or withdrawing from the exchange, right? So it's very powerful, and those wallets are like, identified as on the OFAC list or sanctions and things like that, and which ties to kind of like the second part of your question is like, if we don't solve that problem in a way in which the regulators are comfortable with, nobody's going to trade here, right? So we definitely take that very seriously, and it's like it's embedded within the principles of like how we think about bringing a product to market.
So I have one question. So if we are going for a new order book DEX, so how are we going to scale liquidity apart from market making?
Sorry, can you repeat that? How are you?
If we want to scale liquidity on the order book DEX, initially we will have to rely on market making. That's the initial way you can scale liquidity for different tokens. Is there any other way we can scale liquidity?
Well, I mean, that's kind of the billion-dollar question, right? But yeah, I mean, I think, look, bootstrapping liquidity is hard. There's no question about it. We've done it now with multiple products, and this is our third time, and it's still kind of hard. I think at the end of the day, it goes back to what I was talking about earlier, right? Like, if you want to attract sort of users that naturally want to trade on a platform, they need to derive some utility out from it, right? And so what does that mean? Does that mean, utility can come from, okay, do I want best price? Do I want large size? Can I trade multiple products, right? Like, what does the customer want, right? Now, different people want different things, so you have to kind of trade off, like, which set of customers am I going after, right? So for us, we've decided that we want to go after kind of the pro users because the barrier to adoption for them is relatively sort of smaller, right? And we are able to tap into our liquidity network from Paradigm, et cetera, but that's who we want to focus today, right? Once we do that, and let's say you get to some base level of volume, then you kind of use that volume because volume has network effects, and so you can use that volume to get to kind of the net state, right? So it's very much a iterative process. There's not one thing you can do to say, oh, hey, I'm just going to wave my hand, build something, and people are going to come. It's very much trial and error, and different things, might not work in different markets, right? What works in options definitely doesn't work in futures, right? And so like you have to be mindful of that. So it's a lot of trial and error, and I think that's what some projects are really good at and some people struggle with.
Yeah, and in addition to that, let's say if you want to really quick start the liquidity side, right, what you can do is keep aside, let's say first you need to understand how much liquidity you need. So let's say if you need $1 million in liquidity, have a very competitive pricing model for that. Say that I'm going to give you 6% yield on that. That means for that $1 million worth of liquidity, you're going to spend $60,000 over a year. Now keep that $60,000 aside so that your people are sure that they're going to get it because they're not going to get it from anywhere else. Now, after you have done that, there is a reason why they will have to deposit inside, as Anand also mentioned. They have a utility back to it. And then after that $1 million is put inside, you can hire professional market makers and also mention it priorly to your users that this will be handled by professional market makers and these are the risks that's associated with it, and let the professional market makers do their thing. And majority of the professional market makers, they end up making good amount of, they kind of don't end up making much loss unless it's some kind of a black swan event where I can't comment on. But yeah, that's one of the best ways to like go about market making on your order books, and you immediately get $1 million in liquidity, which means that you can be way better, because the plus or minus 2% depth in majority of the DEXs that are like decentralized and out there is less than $30,000 or $40,000. So I believe like with $1 million you can easily make up to 20, 30 different pairs, and that's fantastic.
Cool. I'm loving the conversation, by the way, and we are slightly above time, and I'm sure we can go for another hour. There are like many important points that we have raised, and I'm sure there's a lot of curiosity as well, because there's a very important topic, and DEXs, knowing that they are the biggest application use case in the crypto world. I'd like to maybe give you one more minute, like any final thought, any advice for new startups that are coming in. Like he asked a question around like how to bootstrap liquidity. Anything related to maybe like how they can fundraise or what trends to follow in one line, if you want to share your thoughts for new people coming into the ecosystem.
Maybe understand the investors. First, check if the investor is whom you want. And the best way to do that is go to their portfolio and see if you can find partners whom you can work with. One of the better ways of bootstrapping and taking it to the top is connecting yourself with the liquidity aggregators that are already there. So check for investors that have invested in protocols such as this, so that the second you get invested by them, you can contact these liquidity aggregators and use the investors to force them and integrate your product. So yeah, I believe that could be, that was a pretty good one for us at least.
It's a lot to put in one line, but I don't have advice, but at least from a product perspective, I think the one thing that's always worked for us is to identify a small group of users and to really like find out like what they need, like what is their pain point, and build a product for that. And even if those users are like 10 or 15, but there's a potential for that to grow, don't focus too much, on how big the market is or all these like fancy VC things like how big is the TAM, etc. Just focus on solving a problem. Once you do that, and you don't need a big team for that, you don't need to raise money for that, and you have something where somebody's using your product, on a recurring basis every day, every week, something like that. That's enough to build a use case and to a product, to a company, and eventually you were able to raise money against that, right? Because investors will fund something that solves a problem at the end of the day. People try to get it the reverse, where they try to raise money before, and then they raise money and they kind of don't know what to do with it, and they end up blowing it, etc. So I think it's important to stay small. It's important to really focus on the user and solving a problem, and then everything else kind of just like follows. You don't really have to try to get investors. They just come to you because you've created value.
Completely agree with that. We actually make sure we interview 4 users a month. We do like in-depth 1 to 2 hour interviews with our power users. We give them small like USDC incentives, but it's been super helpful in helping us shape our product, building our community, and because of that, once you build that buzz, the investors will naturally come. But the other benefit of this market right now, we're on like the cusp of, I don't want to call it a bull market, I don't want to jinx it, but we're on this cusp of a bull market. There's a rise in just non-traditional funding channels again, right? So, launchpads are coming back, but one thing I've been seeing is all the grant programs are coming back. They may not have announced it yet, so don't be discouraged if you don't see the grants out there. Just reach out to the team, because I personally know a few teams who are running grants right now that they plan to announce in Q1. So I think they're all starting to gear up for what we think is going to be this next bull market. And so just outside of just your traditional venture capital funds, look into non-traditional sources as well.
Cool. Thanks a lot, guys. Thanks for taking the time today and joining us for this panel, sharing all these insights. Thank you, everyone, for joining, and I'm sure the panelists would be hanging around for a bit if you have any questions. Thank you.
Thank you.
Thank you, Karan.
Ladies and gentlemen, please give them a huge round of applause. Thank you so much, Karan, for the